Hi everyone and welcome to the next episode of the HeelanHub podcast, the show for small business owners. I'm Dan Heelan. On today's show, it is just me today talking to you this time about limited companies, and actually whether you've got a limited company already or you're thinking of getting a new one, then actually this show is going to have something in it for you, because I think quite often we come across owners and they're thinking, well, look, maybe I'm a sole trader or a freelancer, or maybe I'm just starting a business, and you're thinking, should I be a limited company? Is that a good idea? And as regulated accountants, we come across it quite often on social media. You want to answer that question, but you need so much information from somebody to kind of make an exact call as to whether that's right for them. So I thought what I would do is share some really common scenarios. I think I've got 6 here to share with you of where we see it work well. So you think, look, if you fit into one of these buckets I'm going to describe, there's a good chance that limited is worth serious thought. And actually, if you're a limited company and you're thinking, should I be? Because actually it costs me accountancy fees and everything else to do this. Is it worth it? Then hopefully you're going to get some sort of feeling as to, yeah, actually I am in one of these buckets. It makes sense. So let's get into it. So then I think there's 6 main scenarios I'm going to use on this particular episode. And I'm going to talk to you about, firstly, tax, of course. So going back many, many years, limited companies used to be really, really tax efficient. They were actually amazing. If you went back in time, dividends that came out of the company, so that's where you're the owner and the shareholder of the company. That's very common. You know, if you were to start a limited company up as a one-person company, that's generally what would happen. You'd be the owner, you'd own all the shares, you'd be the director, you'd be in control of the company, responsible for it, and you're going to take your profits. And we've done, I don't know how many hours of shows and videos talking about how you might take your money, but let's presume for now that in general you might have some coming out as dividends, which is the profits to you as the shareholder, and also you might have in some scenarios some small director's salary as you on the payroll, like paid with a pay slip and all that kind of stuff. Now, if that's true, what used to happen is limited companies used to be really efficient. You didn't pay any national insurance, and up to what is now what's known as the basic rate, it would have been a different number, but now would be about £50,000 total income. You used to pay no income tax at all. They had this idea that you had, like, technically, but you were charged 10%, but you counted as paying it. Just meant practically you didn't pay anything. And then even when you went above that limit, actually the tax was reasonable. Now it's a different story. Over time, I think they realized that people were doing this, and it became an easy target when they needed to raise some tax to make a income tax. These times, if you hear me talk about it, I'll often refer to it as dividend tax. And of course, there will be people going, it's not technically dividend tax. But that's how everybody refers to it. That's how, I'm sure you would feel when you look at my dividend tax bill, that kind of thing. So now we pay dividend tax. So now we pay, say, 8.75%, where we effectively paid nothing before. Quite a big difference, but it's still relatively efficient. And this is why quite often incorporations, so starting up a limited company, will be driven by tax. So sometimes actually it's a really good idea to actually just become a limited company to save tax. But those scenarios where that's so obvious are the sort of the break point, I guess, the threshold for that being the case is slightly higher. Now, what I would say is that actually, if you put it side by side, this is you as a sole trader and this is you as a limited company side by side, and you compare the tax bills, actually, you can probably prove on a lot of levels that the tax bill in the limited company is still going to be cheaper than the sole trader, but it's far closer. And what that doesn't often factor, if you just did a straight comparison, is that you're nearly always going to have accountancy fees, particularly as we move into the company's house changes that are coming up. They're removing one of the free tools that a very rare amount of people actually use, but I've been told by Companies House directly that it's more than I thought it was actually. But there was this free tool where you could submit both your corporation tax return for your limited company and your company's house set of accounts to the relevant parties. And that tool was free. Cato was its name. That's being phased out. It's just being turned off. So and I used to say anyway, I think if you had a limited company, you needed an accountant, really. There's too many things in place. You've got accountancy standards, you've got company law, employment law, income tax. There's lots of different areas of law that are involved. So you generally needed one. It's one of those times where I'd say, yeah, you need to. Not the case for sole traders, because I think you can do a lot of good research in there. You have a free tool. You don't need accounts. There's a lot of difference, but that's probably for another show. But anyway, so there's a cost. There's a kind of an inbuilt cost there of needing to pay an accountant, and depending on what kind of service and what kind of accuracy you want, that could be relatively substantial in the picture. And for a lot of like one-person consultants, often we as accountants, we're the highest expense they will have. So you've got to know that there is this inbuilt cost. However, in the right circumstances, it still makes a lot of sense from a tax point of view. So where we find, and this is completely personal, completely just us, if you're at another income level and that works for you, great. keep doing what you're doing. But for us, what we tend to find is when someone reaches about 40 to 45,000 pound profit, that's profit, we tend to see it makes a really good sense. It vastly outweighs the accountancy cost normally, but also there's an inbuilt kind of bonus in the fact that you will find as you're paying payments on account. And I can think, I spoke to a new client who's come aboard with us recently, and she was paying, I think, 30 odd thousand pound in tax in this January coming. And some of that will be tax and some of it will be what's known as payment on account. And I've done other shows talking about payment on account. There's certainly a video demonstrating this on our main YouTube channel at Heelan Associates, where I show you how that works. But normally when you owe over £1,000 of tax personally, there are some circumstances where this isn't true as always, but generally you end up paying a year's tax up front in 2 chunks. So you end up parting with a load of cash over a small period of time. Limited companies themselves don't have this problem. And because of the way you tend to pay yourself, you do end up paying payments on account, but it's far less. And I'll give you some examples in a minute of different income levels of personal tax, but it's quite a big difference. So the actual cash flow benefit on top is really big. So not only is 40 to 45,000 a good limit we find personally, for tax saving versus the costs of having it and some of the hassle, is there's a big cash flow saving in payments and account, and that's big. You know, I think as a growing business, particularly if you're looking to expand, having hold of that money and being able to use it, even if you've got to think and plan, look, it's going to come out in the future, is massive. And it's one of the reasons why, as a business owner, I never want the government to change the way that we pay our tax in terms of this once a year as a limited company. I know big companies pay it more frequently, but you know, most small businesses don't. So because it's like cash is the lifeblood of small businesses and we need it. And having to just know you've got that one bill a year makes a big difference. In reality, it's a really big practical benefit. So that number one scenario of this profits being around that level is a good one for tax. But as I say, it can work at a lot lower numbers. And actually, when we get to the end at scenario number 6, you'll see they actually can work at a lot lower numbers. But if it's your main deal, this is kind of a good level. Now, the other big one is, I told you about that comparison of side by side. You know, we take the sole trade and we take the limited company, and it's not always looking that exciting. But what people often underestimate is 2 things with this: timing and splitting. Timing and splitting. So timing means you're in control of when you get taxed from an income tax purpose. So the way the company works is it pays its tax bill based on what it makes on paper. So the accounts are drawn up, that's the profit. It's quite straightforward maths. That's the tax bill. It'll be somewhere between 19% and 25%. That's it. It's no more complicated than that. Obviously, the tax rules are more complicated and blah, 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 but generally the maths is easy. When you pay a second time, so you pay a second tax bill, you personally, on income tax, and that's what we were alluding to in scenario 1, that income tax bill is driven by when and how you take money from that limited company. So you could actually have no extra taxes if you took no money. And actually, as we talk down the scenarios, you'll see sometimes that's one of the benefits I'm talking about. So timing is massive. So when you do the comparison, someone will show like a £70,000 all going through a limited company and all being taken out in 1 year versus a sole trade doing the same. They haven't got a choice. A sole trader, it's just like it is with a company. It's just whatever's on paper. You know, that's what you're going to end up being taxed. But that is rarely the circumstance that somebody do that. Normally, you're leaving some in the company. You might be doing other things with it, as we'll talk about. And it means that you actually save quite a bit more than the basic 1 versus 1 scenario. And that's why I come across people quite frequently. And they say, can you just show me a side-by-side comparison? It's like, I can, but you're not going to get excited about it because you can't see the dream. You can't see what you're actually going to do, what your behavior is going to mean. And it can mean sometimes that I will actually say, and my team will say to owners who could benefit because their profits make sense to be in a limited company, but we know their behavior is to drain the bank account to zero and not save anything for tax, that kind of thing. It's rare in our client base, but it does happen. There are particular sectors where we see this quite commonly, and they're not going to be suited to a limited company because they're just not going to deal with it. And actually, it's probably going to hurt them from a tax perspective because of the knock-on effect of doing that. Another story, maybe another show. But so there are circumstances. But if you're in control of this and you're working with, and particularly if you're working with an accountant where you're in contact more frequently, it can actually be a massive tax saver over time to just time when you want that money out. Because the difference between that £70,000 example I used, you're going to pay that first 50K's worth of income, you know, those dividends we were talking about, if you were paying yourself out the profit, they're only 8.75% at the time of recording this video, but it jumps to 33.75 when you go above that. Now, if you don't need the extra money and you can do it later, you might choose not to pay that right now. And that's a massive benefit you can't do when you're a sole trade. So timing's big, and being able to control that timing's big. So if you're in a scenario where you don't need all the money, That one's quite good, and we'll talk about that in a minute further down, as I said. And then the other one is if you can split your income by using a significant other. So stereotypically, this is a husband and wife deal. Between you, maybe one of you's on, say, 25, 30 grand in a job, and the other one, this is their main deal. So if you imagine, we said like a stack of books, you can go up to about 50,000, why the money's relatively cheap at that 8 and a bit % rate. Now, if the other person was eating 25% of that up, 25 grand of that up through their paid job, fine. You've still got 25 grand to play with. With the right setup, perhaps they could be a part owner of the company. They could have some dividends. That would work really well. There's a special thing that you've got to do to make sure that you'd be able to split that. But it's very easily done once it's set up. So that could be done. Maybe even if you didn't want to do that, you could pay them a small salary. It'd certainly be cheaper than you paying 33.75 or 40%, depending on how you did it, on your own money coming over in that kind of that 72 grand scenario, 72 grand. I don't know why 72 grand's on my mind today. I think I did this scenario earlier for somebody, but let's say it was 70 grand. You know, you're paying those bigger rates. If you could just take that top 20 grand and bung it on the other person, you're going to pay vastly less tax. And actually, if I gave you an example, if you did 100 grand personal tax bill is normally about 20K's worth of tax. If you did it with like salary and dividends, like is often the case, that's 20K. Now, if you did it between, say, a husband and wife, where you were able to split that 100K, 50K, 50K, they had no other income, you know, you're probably paying like 6.5 grand between them. That is a massive difference in it, 20 grand versus 6.5. So income splitting, and I don't use income splitting like in a bad way. It's completely legal, done properly, and with all the right things in place. It's just arranging your affairs in the most efficient manner is massive. So if it's possible to do that, the maths, when you do that side-by-side comparison, just go out the window. It's phenomenally better. And there's other things that you're not taking into account in there, like can you maintain child benefit? Could you maintain tax-free childcare if you're accessing that? There's a lot of things that go into that as well. So making sure that that's possible. So that is like, if you're in that kind of wheelhouse, that's a big one. Now, you can have the more obvious reasons, like the fact that actually you're forced to. So we see this, and I don't like this one, in all honesty. When people come to us with this scenario, I tend to say, is this definitely what you want to do? So some people are forced into it. So, for example, there's a contract on offer with somebody, and the person offering the contract says you're going to have to be limited. Quite often this is because they feel that there's a employment status problem, a risk of them being classed as the employer or something like that. Tax laws, very well established in this area, and has moved on quite a lot. And actually, a lot of the time, it doesn't really matter whether you've got the limited company or not, but people like to see that separation as another kind of indication that you're not going direct to them as an employee and everything else. But it gets a lot of people in a lot of trouble. We see, particularly with, say, delivery drivers or care workers, we see a lot of people being forced into this. They have no clue how to run a limited company. They don't really want to commit any funds into really figuring out how to do it properly, and they can get in a lot of trouble doing it. So if this is you and you're being forced into it, I would question whether this is something you want to do, but it does exist. And previously this used to be quite big in the contracting world. Everybody you went to, going back say 6-7 years ago, would say you had to be a limited company if you want to contract for me. But it's still very common. So, but just bear that in mind. Because of market forces and the way they've changed some tax rules, it's less now. You tend to come across in those scenarios something known as an umbrella company. Again, not a fan of those, and I don't think HMRC at their core are a fan of these either. I still don't know how they exist today in all reality, but it's where we are. But they're up and about, and they're often an avenue that people now will use instead of doing this. But you still can come across that scenario. So if you're forced to, you might not have a choice, then of course you're going to end up in there. I throw that one in there because it should be said. Sometimes you just don't have a choice. Now, moving on to number 4, I think that there's risk. So one of the key benefits of being limited is that it holds limited liability. So what that means is generally, if the company fails and it owes somebody money, it's not you who's liable. Now, in practical terms, that's not always the case, because if you want to borrow any money as a new limited company, quite often you have to sign what's known in the industry as a PG, a personal guarantee, that basically lets the lender look through the company straight at you anyway. If you went for small business lending and wanted a 25 grand loan, almost certainly you're going to end up having one of these personal guarantees to sign. So it's not entirely true, but there are lots of things where it is true. So for example, if you were registered for VAT and you got into trouble and a customer didn't pay you, the business had to fold, and all that was left was the tax debt, quite often that tax debt will just disappear, whereas you personally, your house, anything else is up for grabs. So just that extra level of protection is really important for some people. So I like to see it, if somebody's going to be an employer, I think people underestimate the risk of being an employer these days. It's so easy to get something wrong that ends up with you with a 5-figure, 6-figure claim. Maybe not six might be exaggerating it, but quite frequently we see 20 to 25 grand claims on clients where they've had, that maybe they have mismanaged it, because again, nobody teaches you this stuff, or at least they're having to defend that claim and they have done something right. And all that risk going in the background can be really hard work if ultimately your assets, your house and things are up for risk. So I think if you're going to go VAT registered, or you're going to, certainly if you're going to become an employer, that tends to be a really good place where really strong consideration of a limited company tends to be practically worth it because of that limited liability. And if you don't know what limited liability is, just do a bit of research, but just think it's almost like it stands as a barrier between you, because the company is its own legal thing and it can sign contracts in its name. It means that, anything, it's got its own debts. If it owes the tax office money, it owes it, not you. There can be, as I say though, there's a lot of scenarios where that can't be entirely true, because maybe the directors nicked all the money that should have been paid to the VAT office, and then in a liquidation scenario they're going to be asked to repay it, things like this. But the most general time I would see it is if you imagine, I don't know if you can cast your mind back to when Carillion, big contractor, fell down. We had a lot of people in the construction industry chain that were further down. Suddenly they couldn't operate because they weren't going to get paid, say, 200 grand from Carillion. The director hasn't had it. They're now 200 grand short they're never going to see. And suddenly the business isn't solvent anymore, can't trade. And it ended up leaving tax debt, for example. And then they've been able to really, what generally happens is they've still got the skills and the contacts. They'll probably start up again tomorrow and carry on. But that was outside of their control. It's those kind of pitches. But it tends to be a good idea if you're in that kind of risk zone where being a limited is good. Now, when we're talking about supply chains and things like that, number 5, I would say, is if there's a reason that you need to look more professional and bigger than you are, I think a limited company does add that kind of level of professionalism to it. And also surety. Someone can physically search you online. They can see how long you've been in existence. They can see that maybe your accounts are up to date and you've been paying attention. I know as accountants, we can almost see somebody's attention to their admin by looking at their company's house record and seeing what they've done and what they haven't done and things like that. So if you want to look bigger than you are, obviously you need to keep those things up to date, but having a searchable company does feel good. You can get your macro card or whatever else. I'm sure other discounters are available, but I know people like that one. So making sure that you've got it there if you need it. And not always, but if you go back to where we started, because there is an inherent cost normally with accountancy and other costs, and also just admin and hassle of running a limited company, means that, just because you want to look bigger isn't the prime reason, but sometimes it can be. Somebody really they're going for a big client and they want to look a bit bigger than they actually are. And at the minute your profits and things are completely private on Companies House, if you've submitted the right accounts, they can still see a snapshot of the overall position of your business, but not in terms of what's your top line revenue or sales, what's coming in, or your profits. They can just see kind of what your assets and liabilities are. So what do you own, what do you owe, that kind of stuff. And even then they're like compressed subtotals. So you can't really see that much depth into them. It gives them a bit of information, but not a lot. So as a result, you can look bigger than you actually are, which can be kind of a commercial but positive, I guess. And then number 6, I did speak about at the beginning, is this idea that sometimes side hustles are good as limited companies. Now, I reckon we probably spend at least half our time talking to a prospect. I want to say prospect, sounds a bit salesy, a prospective client about whether they want to go limited or not when they're freelancing and they've got a side hustle. And I reckon we spend half that time talking to those prospects saying, don't be limited, be a sole trade, see how it goes, make the decision later. Because it's so much easier, cheaper, less regulation to be a sole trader that actually, unless you need the hassle and all the other things we've just spoke about being a limited company, so frequently it's just easy to test the ground and try, and there's nothing wrong with it. Just that's a very normal journey. So that would normally be the way a side hustle's done. But at some point, sometimes it reaches a point. So I can think of at least a couple of clients recently, they've just gone through our Launch Limited program, which is kind of like our get your company launched accelerator, that kind of thing. There's a full program to teach you what you've got to do, what systems you need in place, how to bookkeep, how to structure, and we get involved with structuring the company and making sure they're all set up for the right tax efficiencies, all that kind of stuff. I'm just thinking about a few people that have been through there. Some literally in the last month, some of those have ended up doing that, and actually their income might only be say 10 to 15 grand, but they're on a growth path, and actually they're already a higher rate taxpayer. So if they've done that as a sole trader, they'd have been paying 40% tax on all of that money. Whereas actually they didn't need the money. They just wanted to leave it in there and wanted to let the business grow and reinvest it in the business. The company will only be paying tax those kind of like 10 grand, 15 grand profits at 19%. Big difference between 40 and 19. And if they're not touching the money personally, they're not paying any secondary income taxes. Now, obviously, eventually, if they wanted to draw the money out, they would. But for a lot of people doing these side hustles, they're not. And maybe actually if you've got long-term visions of paying into your pension, or you want to invest it in property, something like that, it can be a really good way to start a fund to do that. There's quite tax efficient ways of doing these kind of investments by not touching the money personally. And again, we've done other shows on that, and I'm sure there'll be even more shows where we talk about those things again. But having that side hustle where you're like money boxing this money and then just reinvesting in the company is a really good way to protect it. Because we said at the beginning, having cash when you grow in a company is really, really big, and having to give 40% of it away in tax just because to have it sitting there is just horrible. Whereas actually 19% of it, okay, fine, we'll give you 19% of the profit, and then we're able to build with the rest. Maybe we buy new equipment, maybe we reinvest it. Or if we did want to access it personally, well, there are ways of paying it into a pension, for example, if you structure it right, where it can come out of the company into your hands for later and very, very tax efficiently, and even potentially wipe the company tax bill out, just as an example. So there can be reasons to do it. But I think you have to be, sometimes you're a combo of these situations, but I think you've got to just be wary that you need to, like, these are common scenarios. If you're really testing the water, so you've just gone, I'm going to be in business tomorrow, I don't know if it's going to work, I'm going to start advertising, just often the answer is just be a sole trader. You can always turn yourself into a limited company later. Now, there is tax things to worry about when you do that, but 9 times out of 10, for a one-person consultant who's doing a bit of copywriting on the side or a bit of social media marketing and wants to incorporate, then there's very little challenge with doing that normally. So just bear that in mind, you can do it later. And I think always, if you're thinking of going into a limited company and you're already a sole trader, you're transitioning, it's probably worth speaking to an accountant or tax advisor, somebody who knows how to do this stuff, just to make sure actually it's not that you're doing anything wrong, so you're not missing some opportunities, because quite frequently there's some opportunities in there to go. So just do your own research always. I'm just some guy on the internet. Okay, I run an accountancy business, it's regulated, so I have to be careful about what I do say. And you'd hope that, from my point of view, it's absolutely great information that is from lived experience, but do your own research, because where I started at the top of this is it's all very dependent on what your exact situation and what your goals are, and can you split it. So for example, let's give you this. Let's say actually you have got profits over 45k, but you've not got a significant other that you could use any tax allowances with, and you want to drain all the money to live on personally and pay personal debt, you might decide actually when you weighed all that up, it's not worth it, for example. So, but the other hand, you could be a 10 grand company and you're a higher rate taxpayer paying 40%, and it makes complete sense for you and your goals, because actually you don't want to touch that money. So you can see, hopefully, how this kind of moves from one side of the pendulum to the other, limited, non-limited, depending on your exact scenario. So bear that in mind. But yeah, so takeaway for this, there's some common scenarios for you. If you fit into any of those buckets, seriously consider it. Do your research. Don't assume that it's an automatic, though. Do your research and reach out for help if you need it. And if you do need help with actually getting the company going, you've made that decision, it's there, or you just need some help figuring it out, we do that stuff as well, of course, then get in touch with us. If you go to our website, actually, heelanassociates.co.uk/startmycompany, you can see our Launch Limited program. That's super popular. We have an intake every month for people we take on there. Now, hopefully you've enjoyed this show. If you have, you can also check it out and you can watch us on YouTube. At the minute, the shows are slightly behind. We're changing the technology behind it to make this a bit quicker, but currently the shows are slightly behind. So if you're listening to this and you think, actually, I could do with going back and dropping a couple of comments in the YouTube there and talking to Dan and the team, and I've got some questions, you can actually do that, but it is a little bit behind at the moment as the time recording this show. So that's on, if you just go to YouTube and search the HeelanHub, there's a separate channel. So we've got our main channel at Heelan Associates. You'll tell the difference because one's got like 50,000 subscribers and the other one hasn't. But if you do like the show, please do subscribe there as well. That'd be cool. But we'd love to interact with you. It's always quite cool to be able to talk to people. It's what I enjoy about some of the other social medias we do. If you have enjoyed the show, obviously do subscribe via your favourite app. It's amazing the amount of people that listen to this regularly that aren't actually subscribed, so please do that. And if you can, I'd love it if you leave a review. It's great for our visibility. You can also find us for more business insight and tax tips across all the social media channels, including, of course, YouTube, Insta, TikTok. We're doing a lot on there at the moment. LinkedIn, of course, Twitter, Facebook. all the usual places you would find us. So make sure you do that. And if you want some information direct to your inbox, so you like the emails, you can go to heelanhassociates.co.uk, scroll up and around for a bit, and you will get a pop-up that will pop up, and you can put your email in there, and you can sign up to our HeelanHub Herald, which is an email direct to your inbox every 2 weeks with tax tips, blogs, videos, all the kind of stuff that you might be interested in. Finally, if you do want to get on the digital journey, so maybe if you're listening to this and actually you're either a sole trader doing over £50,000 or you're thinking of getting yourself into a limited company, cloud softwares, for me, you've got hours and hours of content where you'll hear me talking about the benefits of cloud accounting software. Xero is the market leader. Xero is my personal favorite and many of my team's favorite. You can get a really great deal on a license for there. So if you go to heelanhassociates.co.uk/Xero, and that's Xero with an X, you will find a great, really, really good deal at the moment, at the time of recording this, on a license. Helps you, helps us. If you want to get in touch about the podcast directly, you can do so at info@heelanhassociates.co.uk. That's it. Have a profitable and tax efficient week, and I'll see you in the next one.